Hey guys, welcome to the podcast. Thanks for joining me. I appreciate it. Welcome back to trading. We had, of course, abbreviated session on Friday, a very big move on Friday as the market was open just a half a day. Closed at noon Central Time, 1 o'clock Eastern. Hope you all had a great Thanksgiving. We had 21 people, and I actually only had one helping this year. So I was actually pretty good and didn't go back and have leftovers that evening. So that's a first for Mr. Eggers. I don't know what the cause of that was, but I'll take it. Right? It's a plus. I probably made up for it the next couple of days, but that's another story. Anyways, here we are. The markets. Of course, if you did miss it, 172 points was the Dow Jones gain on Friday. A lot of people were saying, well, you can't look at Friday because it was low volume. Well, of course it was low volume. The market was only open a half a day. What you have to do is compare Friday's volume post-Thanksgiving to prior post-Thanksgiving volume days, and what you would find is that it was right in line. So, yes, it's not necessarily, how much can you glean from that? Not as much, but I wouldn't say, well, it was light volume because it was the appropriate volume for how much time was in the day. Now, today, the volume was very low. I mean, this was one of the lowest. I think it was the lowest volume day on the NYSE, the Monday after Thanksgiving. It was the lowest Monday after Thanksgiving volume since 1996. So now, the bulls would say, well, we had, it was going up on better volume and went down on lighter volume today, or it went up on average volume, we'll call it, and down on less volume today. But regardless, the volume, look, I haven't made or lost money on the amount of volume in a long time, except at capitulation times where the volume is really, really high and you get this massive sell-off, and those two things meet, where you have a big sell-off and the volume spikes at the same time. Then that's when volume has really mattered. But in the last few years, volume's been declining, and it is a problem in the big picture. But from day to day, I don't pay too much attention to it unless something really unusual happens or you're looking at individual stocks. But the important thing was Friday was a 90% up day. Now, why is that important? If you go back and listen to prior podcasts, what we talked about was we had the 90% down days. We had two of them in the last few weeks, and that showed really intense, powerful selling. And that's what you need first to get to a bottom, right? You can't have selling unless you get to a bottom there. Excuse me, you can't have a bottom unless you get some selling. But you had these washout days. The next thing was we knew there was going to be a rally, but was it going to be intense? Well, we had one 90% up day, very, very strong rally. And then a couple days later, Friday, we had another 90% up day. That is what a classic bottom looks like, and we'll go through that. Now, with that said, here we are, November 26th. We have just a little bit of time before the end of the year. The fiscal cliff is looming, still in everybody's minds. Most think that we will avert the fiscal cliff, but probably it's not going to be a major deal. In other words, there's not going to be huge reform, and it's just going to be enough to avert that particular cliff or lessen the blow, so to speak. But we have that in front of us. So for us to say, well, that was a bottom, tradable bottom, rally, is it a long-term buy? It's hard to say yes, you can make that case given the circumstances. So, but if that wasn't involved, if we weren't at the end of the year, I would say that that's what a classic bottom looks like. Washout, just a horrible few days there where everything was getting tossed out. The charts looked awful, and if you could stomach through it, and I said we're at a point where if you haven't sold, don't. I didn't sell anything throughout that time frame. What I did do was I bought some Apple during the downdraft, which was I bought basically for I didn't average down. I basically bought a new position for anybody that didn't have that particular position for the accounts that I manage. But we did go in as an aggressive trade, bought biotech during the downdraft. We bought some mid-caps, what I had mentioned last podcast. So we didn't sell anything. If you didn't want to buy it, that was understandable. But to go in and sell it when you had all those technical indicators screaming that it was oversold, that was the right thing to do not to sell. If you didn't want to buy, that's another story. But we have had the ramp up, and you can see, today was kind of a mixed day, but not that bad considering. I mean, and we'll go through in just a minute the charts, but you'll know that, we did have a bounce. To have some pullback would have been perfectly normal. Now, it had the potential to get really nasty. We were down over 100 at one point during the 11 o'clock hour, and it slowly started creeping back a little bit, and we finished the Dow Jones only down 42 points. You can see the volatility was up, which is good. You're getting that fear. At the same time, we're not really getting a hard sell-off today. The Russell was up 0.25%. We had financials were lagging. They were the laggards. We did have utilities up 1.2. They were the leaders on the day, and we'll get to that in just a minute as well. And you can see all the S&P, only down 3 points on the day. So pretty much a mixed bag, but for the most part, not too much damage after we had that, the big, huge run last week. Okay, so today still is, it's only a little bit after the market closed, but it is Cyber Monday, that sounds so 1996, doesn't it? Cyber Monday. It's almost as bad as the information superhighway. But it is Cyber Monday. Sales right now look like they're going to be up about 26% over last year. But before you get too excited, realize that there's still a transition of people that are replacing physical shopping with online shopping. And so you're not comparing apples and apples when you just say it's up 26%. It's going to continue to be up every year, even if, nominally it looks better. When you look at it and compare apples to apples, it's still probably up from last year, but not as big. Now, if you looked at I tweeted this out earlier too, an article, if you want to go check out twitter.com/Karl Eggers. But on there, one of the things I put out today was the 12 days of Christmas. They have this basket. If you actually went and bought the 12 days of Christmas, what would it cost? It was up 6% this year versus last year. So maybe that's the best inflation gauge we have. I don't know. But things are costing more. We know that. Well, here's the market, the S&P intraday. And you'll notice that we had the big drop right when the market opened, kind of bounced back a little bit, and then it started getting really nasty, and you thought, this could be some real profit taking here. And then it recovered, but it kept recovering, giving some back, recovering, looked like it's rolling over, and then, of course, we rallied into the close. So, again, not a bad day considering the big up we had last week. It's very normal to give some back, and that's exactly what it did. So we had the big drop, of course, over the last few weeks here, and this was an area that was pretty interesting because it really held up nicely here. We had this Bollinger Bands getting really, really tight, so you knew it was going to break one way or other. It did. It broke in anticipation of QE3. QE3 finally gets delivered here, and that was pretty much the top. Now, that was a pretty nice line in the sand for support, and you can see we bounced off it a few times, and the bulls were thinking, okay, we averted disaster because we had this big up day. It looked like we held. Everything was fine. And then, of course, this day we broke through it, and that was it. And then, of course, went on down through the 200-day moving average. Well, if you extend the line on over, you can see where support is here, or resistance, excuse me. And for those that don't know, support would be coming down, kind of the floor. Resistance would be the ceiling. So this is a natural place where we would try to come back, pause a little bit, and then if it's a real rally, up we go. If it's a continuation of this move, then we would just keep falling. And and I anticipate that the 200-day moving average will hold this time, and that this rally isn't necessarily over. I think even some bearish people that I follow and watch and have conversations with, they kind of feel like that we're in a rally mode, and so you still buy the dips temporarily. Not to say everything's resolved, but the momentum is definitely, on the bull side. And again, given today, this is a perfect opportunity for everything to really sell off, and it really didn't do that. Now we've added the another coincidence about this level here around 1406, 1410, something like that on the S&P, is that if you look at the Fibonacci lines, which I actually drew I drew this back in, I think on a previous podcast at one point, But from the high to the low, you'll see that basically 50% of that is right at the level we stopped at on Friday and the level we're at today. So another logical place for the market to stall. And again, after the big run that we had, you would expect some pullback. Maybe down here to the 1393 level, somewhere in that range, we would pull back a little bit. And then again, if it's a real, beginning of something bigger, then we would move on up. We have the Santa Claus rally that could be taking place. The thing, though, is, and we talked about volume just a few minutes ago and how it's kind of ridiculous to look at the Friday's volume. It wasn't a full day, but looking at it in context, maybe on an hourly or whatever the case. But in general, though, we're still seeing this declining volume. So, that's not great. And today was a little bigger, but we did see declining on this way up and a little bigger on the way down today. So not the greatest, but again, I will point out that we've had two 90% up days here, which is very, very, very important. So that was very bullish. All right, utilities. Promised that we would discuss utilities. They were the outlier today, up 1.26% on the day, based on the XLU, which is the big ETF owning the biggest utilities. And a lot of you have been asking, is this the time to buy it? Is it good for long-term investors that are looking for income? The yield's 4.5% now. So, yeah, I think it's taken the brunt of this, most of its fall, due to the fact that after Romney lost and Obama gets reelected, it was a foregone conclusion taxes are going up. And because of that, this is one of the few things that was probably justified in going down because of the fact that these are taxed as dividends, whereas a lot of stuff that fell during the sell-off was not taxed as dividends, so it's kind of ridiculous it was going down. But you can see volume had picked up. This was going down. It got kind of overdone, and pretty relentless selling. But what you've seen in the last few days is, and I'll draw a little box, it kind of started to bottom a little bit. And and we saw on Wednesday, I put a tweet out saying it looked like a capitulation day. Let me switch this to 5 minutes here, and we can go back and look on Wednesday, not Friday, but Wednesday had a real intense sell-off. Volume picked up intraday. This is a 5-minute chart, and then reversed and finished up, pretty even on the day. That was very bullish. That was again one of those capitulation days where the selling just dried up and there's nobody left to sell. Kind of a weak day on Friday. In fact, it was down on Friday, which was very strange given how strong the market was. But it came back today strong, kind of gave up some of those gains. But what you're seeing is a lot of call buying in the XLU right now. So people are making some very bullish bets on utilities over the next few weeks. And I think another reason why utilities have been struggling was, because of Hurricane Sandy and some of the disruptions in utilities and so forth. So, and possibly more regulation coming down the road after Sandy. So all these things culminate into a big, massive sell-off. And again, if you're looking at this, I think you probably the spot, if you're looking for it as a couple of things. I think it's an interesting area. Kind of your stop goes somewhere down here. But I think if you're somebody that's looking to get out of it, then what you're looking to do is probably see it rally back to the 200-day moving average, maybe even the 50 if the 50 keeps coming down, and that would be your area right in here to sell. But look, I don't know if it's a long-term buy. I think the story still makes sense, but boy, they're out of favor, and when they're that out of favor, they at least need to be looked at for a buy. It's hard to say anything's really long-term right now, but yes, I think that capitulation on Wednesday was a bottom. But just keep an eye on them because, again, if the fiscal cliff talks don't go well, taxes could be rising even more than people think. And, dividend tax goes up more than people think. XLU will get hit probably further. All right. Apple, big, topic of the day, up over 3%, $18, almost $590. And we've talked about the different phases of Apple as it's been falling. You had some fundamental deterioration, some revenue and earnings deceleration. So in other words, they're still growing really fast, right? But they're not growing as fast as they were. Instead of growing at 90%, maybe they grow at 70% and so forth. So you do have that. So you had some adjustment. The second phase was those profit takers saying, "Uh-oh, Apple's falling. It's breaking these trend lines. I need to go ahead and protect profits." And the third phase, and by the way, selling in anticipation of next year's capital gains hike, which is coming. And then the third phase was just, margin calls, hedge funds that had been holding on this, using Apple as this, it was just a core holding, and they kind of capitulated. So you saw this thing really sell off, and I've owned it for a long time. I did not sell one share through this, and in fact, like I mentioned earlier, actually went in and bought some on this day for people that did not have that particular position. And so far, it's been a great move. Here's the thing, though. Apple has bounced, and it was actually bounced off this little support, and we talked about this last time, but it bounced off of, an area where you thought it was possible. It did do that. Very, very heavy volume. So that's probably a good level that may not be breached. But here's the thing I want to point out. First of all, you have the 200-day moving average, and I've extended it here just to show you where it might end up. Around $600, we'll call it. So that's going to be the first test for Apple. Number two, you're going to have this line coming down and crossing, and that would be very bearish. So, you're going to have a lot of stuff happening probably in the next couple of weeks for Apple. But in the bigger picture, here's something that I'm cautious about, and that would give me pause to potentially sell the stock. You could be setting up for a big, massive head and shoulders. So we've got this left shoulder, we've got this head here, and could we get a right shoulder somewhere up in this area at some point in the future? Does it work its way, kind of pull down, and then come back up, and then eventually start to head down? If that's the case, then I think Apple may be looking to be sold. And look, the fundamental story is still intact, although it is a little less than it was maybe 2 or 3 months ago. They're going to have a great Christmas. Think they're going to report great earnings. Everything's going to be fine. But if it does have trouble there, that may be your chance to sell. And again, look to get back in at another spot. If it falls, will it fall further down than this? I don't know, but I'm just telling you that we've had a nice bounce even further today. Good volume today, and if it follows through and breaks on through the 200-day moving average, this is kind of your spot, which is, we'll call it right in here. The high was 644, so we'll call it 644, 645. If that happens, and again, if it rolls over at that point, that may be, something to take in consideration. So a potential head and shoulders, and I may do a blog article, so it may be some repetition tomorrow, but for those that missed the podcast, I may just do an article on what this picture might look like. So watch out for that. But that's something that I'm seeing as a potential again. But fundamentally, I like the story. It's a compelling stock. They're going to do a buyback probably. Probably no major acquisition with $125 billion of cash, but they'll probably raise their dividend. So you could get a stock that could be yielding 3% at some point. Look, we've looked at their balance sheet, their income statement, all of that stuff, and poured over the financials. This company could easily do a $50 per share dividend. That would be very simple for them to do. I don't think they'll do that much, but they could do a special dividend plus a dividend hike plus a share repurchase. All of that would be bullish, and that may be a time to say, great, I got all that. The stock flew up, and if it pauses and starts to roll over, then we may consider taking profits on Apple and looking to get back in at another level. So that's something that's developing, but for those that sold, during the November sell-off down here, bad trade. All right, I'm showing you Amazon. I do not own Amazon, but you can see it did bounce off the 200-day moving average. Now it's close to the 50. But the reason I mention Amazon is because if you look at the top 10 items searched for today on Google and around, gifts, 3 of the top 10 were Amazon Kindles. Amazon Kindle, Amazon Fire, and the Amazon Kindle Fire HD, which are 3 separate products. They were all in the top 10. So I think Amazon's going to have a huge Christmas, and it's a very expensive stock. I'm not saying to go out and buy it or anything. I don't own it. I'm not planning on buying it right now. I'm just pointing out that pay attention to some of these stats that come out because, they can mean. Now, look, Amazon Kindle, more than likely, is a loss leader for Amazon. The idea is they sell this tablet that maybe doesn't make them a bunch of money, but when you get this Amazon Kindle, it's already, they make it very simple for you to purchase stuff on Amazon, right? And that's where they make their money. In addition, they have something called Prime Video, I think it's called, and basically it's kind of like a Netflix streaming service. With that, if you order that and you get these movies and downloads and TV shows and all of that, not only do they give you free storage on their website for your Amazon purchases, but for music and all of that, but in addition, they will let you have all of your shipping. It's free. So if you're somebody that buys a lot of stuff on Amazon and you're going, should I get an Apple iPad mini or should I get a Kindle? The Kindle probably makes more sense because it's cheaper. You get free shipping if you do their Prime service, and you may say, I'll do that instead of Netflix. So just watch Amazon here because I think it had a big, it's having a big day right now. The Amazon Kindle Fire was the number one seller today, on sale for $129, and so I'm not going to say what I bought, but I did participate in Cyber Monday for somebody who probably isn't listening to the podcast, but maybe. But I will just say I bought it at Amazon. That's all I'm going to say. And, hey, took advantage of it. So that's it. Short podcast today. Just want to give you a quick update on that. We're kind of in no man's land right now. I expect a little more of a pullback, but I wouldn't be tossing the towel just yet on this rally. But if you have some things you were wanting to get out of a week or two ago and you were dying to get out of, you've had that relief rally. Now put your stops tight if that's what you're wanting to do with those particular positions. All right. Hey, don't forget eggerscapital.com is the money management website. There's also a free subscription on karleggers.com at the top right. And also you can go to twitter.com/karleggers and, of course, Facebook and Google+. All right, guys, have a wonderful evening. We'll talk to you soon.